If Tesla is one of your largest positions in your portfolio, then probably your portfolio is looking quite good today. Now, of course, the overall market is doing quite better. Tesla specifically is up close to 36% since early August. So, could say we've seen a nice little recovery in the stock despite no real specific company focused news, right? We're all waiting for the next earnings report, earnings call, and of course the 1010 event, the robo-taxi event. Now, there is definitely quite a lot of expectations, I would say, going into that event, especially from Wall Street. So if it disappoints or does not blow everybody's mind, then I would say it would be a sell event type of day. Now, this is not me saying that, oh, we're going to be disappointed, but the fact that it was delayed because they wanted to make sure that they show us something quite significant, then yeah, suddenly the bar is raised even higher. Now, what do I expect? As you know, I expect a demo, which I think is why we've seen those leaks and we've seen the reason why they are doing this in the Warner Brothers studios. I expect a demo. I expect a couple of models, not just one model, for the robotaxi and for the next generation vehicles. And hopefully we get to see a little bit of Optimus as well, the next generation or the next version of that. I think if we get all of that, we will be quite happy. Now, again, these are things that will only have a material effect on the bottom line or even on the top line for Tesla, other than the next generation platform, in quite a while. 12 months, 18 months, maybe a couple of years from that event. So I hope that makes it clear where I stand on the 1010 event. Now, why is the stock up so much? Well, first of all, the market is up. Interest rates aren't going to come down, so definitely sentiment shift. Plus, we know in a lower interest rates environment, companies like Tesla, car makers, if you sell cars, lower rates usually helps with sales. So that helps the cause here. Plus, we've also seen some great numbers out of China. It continues, as you will see in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comments with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with the Tesla weekly insured number. That number came in at 15,600, another strong week for Tesla in China. And year to date, we're now up 1.9%. And I do expect that trend to continue. Again, the strength in China, of course, thanks to the great incentives there, is great. To increase volume might not be the best thing for margins, but I mean, when margins are better but volume is not, then people complain. But now that volume is up but margins might be affected, people will complain as well. Me personally, in the short run, I do prefer seeing more and more Tesla vehicles on the road, collecting data, and you can always upsell software, insurance, stuff like that in the future. So great to see the strength in China. Then, if we look at the model mix, I believe it was 81% or so Model Y. Yes, despite a refresh Model 3, people still like to have and go for the Model Y, especially because of its size. And also despite the fact that many of us have heard the rumored refresh, so far it does not have a negative effect on sales. Moving into the United States, well, in the United States, if you look at new vehicle share of registrations by model in 2024 through Q2, at the number one spot, we have the Toyota RAV4. No big surprises there, but slightly behind it, we've got already the Tesla Model Y. So the number one is the Toyota RAV4. Share in the first half dropped to 2.8% from 3.2%, just a hair ahead of Tesla's Model Y. For the Tesla Model Y, share rose to 2.8%, its highest share ever, up from 2.6% in Q1, a hair away from being the number one best-selling car overall in the United States, doing better than the Ford F-150, the Honda CR-V, and the Chevrolet Silverado 1500. So, yeah, I guess we've got some positive momentum in the United States, in China, but not in Europe, or at least not in Tesla's biggest markets in Europe, as we've discussed in the past, Germany and France. So, in August, registrations for battery electric cars declined by 43.9% to 92,627 units, and the total market share slipped to 14.4% from 21% a year before. The decline was driven by sharp drops in Germany, 68.8%, and France, 33.1%, which are the two largest markets in Europe. From January to August, 902,011 new battery electric vehicles were registered, representing 12.6% of the market. Plug-in hybrid cars registrations saw a decrease of 22.3% in August, which decline recorded in all their major markets. In August, plug-in hybrids accounted for 7.1% of the total car market, down from 7.4% last year, with 45,590 units sold. Hybrid electric vehicles were the only vehicle type that saw growth in August, with car registrations rising by 6.6% to 201,552 units. Now, the European Automobile Manufacturers Association said the continuous trend of shrinking market share for battery electric cars in the European Union sends an extremely worrying signal to industry and policymakers. In response, the organization urged the European Commission to bring forward the CO2 regulation reviews for light-duty and heavy-duty vehicles, currently scheduled for 2026 and 2027 respectively, to 2025. Now look, there are many reasons why this is happening, but just try and make the best car possible, sell it at the best price possible, and of course with rates coming down, that should help it as well. And of course, education is key. So yeah, maybe Tesla should be advertising a little bit more, maybe definitely more, to educate the public on electric vehicles in Europe. Of course, expanding the supercharger network is also key in Europe because it's not as big as in the United States, for example. It's definitely something to take into consideration. But yeah, we've seen this already. I've been covering week after week. We know that Germany, France, even the UK has been weak, but the Netherlands, Belgium, for example, even Italy have been a little bit better. And like I said, in Europe, you can buy cars for 20,000 euros, 22,000 euros. For example, the new Volkswagen Golf, I think it's 23,000 euros or something like that. That's the starting price. It's definitely much cheaper than a Model 3 and a Model Y. Moving on to our favorite blog post from Adam Jonas at Morgan Stanley. So we've got two of them in this video. One here, Tesla and XAI, living in a simulation. Tesla shareholders should understand what's happening at Elon Musk AGI startup, XAI, the common denominator, training and simulation that's deterministic to Tesla's future in robotics, autonomy, and manufacturing. Heading into Tesla's 1010 Robotaxi event, we are frankly struggling to see how the day can live up to investors' high expectations. This is why I started the video with sharing my thoughts on that. Other than demonstrating FSD version 12.5 and offering rides in a Gen 1 Cybercab, what else is in store? Perhaps there will be a detailed total addressable market analysis showing tens of trillions of passenger vehicles miles and tens of trillions of dollars of potential recurrent revenue by 2050. Yeah, the more data, the better, right? So what are they looking for? Safety, improvement, methodology. Do they expect Tesla to drop a major Optimus update on the market? Anything's possible, but we don't think so. We think we'll have to wait for another day. I think that will be a missed opportunity. That could be a great, we've got one extra thing to show you, and then bam, a huge update from Optimus. I think that would be great. Moving on to the second one here is basically talking about Legacy Auto paying for Tesla's AI infrastructure. Basically talking about Ford. Think of this. Is Ford going to potentially fund Tesla's AI data center growth? Ford has disclosed it has accumulated firm commitments to purchase approximately $4 billion of ZEV credits to maintain fleet compliance on CO2 emissions globally in the years ahead. On our estimates, given Tesla's share of the markets where Ford participates, that as much as 50% of these credits would be potentially purchased directly from Tesla. Tesla disclosed at the end of the second quarter it had $2.5 billion of AI infrastructure within its PP&E, that's up 65% year over year. Therefore, in an effort to reduce emissions, Ford would purchase ZEV credits from Tesla with a 100% margin to Tesla, which Tesla would in turn use to add its own power-hungry and CO2-emitting AI supercomputers. Is it just us, or does this seem ironic? I think they're right. They also say here in their latest Global Insight, the Morgan Stanley Global Sustainability Team forecasts that global data center build and their electricity use will amount to 2.5 billion tons of incremental greenhouse gas emissions from 2024 to 2030, equivalent to more than 40% of annual US emissions and 3x the DC industry emissions in a scenario in which no Gen AI development existed, which is also probably why we're going to see, again, continuous increase on the Tesla energy side of things. Because, I mean, it would be quite ironic, right, for all of these tech companies to set their zero carbon goals by 2030 or something like that, or even Tesla, right, EV makers. But on the flip side, you're building out huge data centers which are polluting quite a lot. So, yeah, they're all definitely going to have to do something to clean that, to greenwash all of it. Lastly, here we've got quite a lot of news with regards to the Tesla Semi. So PepsiCo said that their drivers who operate the company's Tesla Semi truck have reported that after driving the electric truck, they don't want to go back to driving a diesel one. Tesla says they have an all-electric Tesla semi-truck in their fleet that has operated for less than 18 months, and it already has driven over 250,000 miles in that time frame, and those miles have all been done at North American gross vehicle weight limits. PepsiCo says that they currently have 89 Tesla semis in their fleet. Tesla's head of semi-engineering, Dan Priestley, says Tesla semi-trucks have driven over 4.66 million miles, up from 3.5 million in May. That's a fleet average of over 9,600 miles per day. He also said that they have successfully demonstrated and deployed megawatt-level charging in the field. It is safe, it is reliable, and it enabled a one-for-one replacement for diesel trucks. PepsiCo did a demonstration of more than 1,050 miles in a single 24-hour period, and that is enabled by fast charging. Dan Priestley also said that Tesla has been able to replace all their diesel trucking with Tesla semis at a lower operating cost and without compromising schedules and without compromising payload. Efficiency is key. And I think the Tesla Semi is going to be an enormous business for Tesla. And of course, it also will show plenty of people that, oh, actually EVs are a thing. You can survive, you can go on long trips, charging is not an issue. Of course, not everybody is going to buy trucks, but it's definitely another funnel to lead them to a Model 3, a Model Y, an S, an X, maybe a future Model 2 of some sorts. And so that's about it from me in this video. Of course, the stock right now is nearing the resistance point, around $260 or so. But I mean, there is quite a lot of momentum with the stock and the overall stock market right now. Could we break over $260, $270 this time? Remains to be seen, of course, as we get closer and closer towards that earnings report. That will definitely be a catalyst. Other than that, the 200-day moving average sits at $209, the 50-day one at $219, and the 20-day one at $227. Quite exciting times ahead, especially in the next month. So yeah, that's about it for me. Do share your thoughts down in the comment section below. Like, subscribe, do all of that. And I'll see you all in the next one. Bye-bye.